What if the tax break you counted on this year suddenly becomes the tax trap of tomorrow? Because over the next few months, several tax rules labeled temporary may become permanent. And if you don't act now, you could be paying more without even realizing it. By the end of this video, you'll know which tax rules are up for a major shift in November, how that could affect your savings, your investments, and your retirement plan, and the steps you can take right now to protect yourself and stay ahead. Number 1. Temporary deductions and credits under review. Canada introduced a number of support measures during inflation and cost of living spikes. Deductions and credits meant to expire. But in recent budget discussions, there's strong momentum to make at least some of them permanent. What that means: if you've been benefiting from something like an enhanced refundable credit or an inflation-adjusted deduction, it might either phase out or morph into a less favorable version if you don't lock it in by November. Make sure you know which credits you're using and whether they're listed as temporary. If they're not renewed, you'll effectively pay more tax next year. Number 2. Capital gains and inclusion rates may shift. One of the big buzz items is the proposed change to the capital gains inclusion rate. Although the full change wasn't implemented yet, many tax planning experts believe legislation will try to lock in higher rates this November. If the temporary lower inclusion rate disappears, that means your future gains on property, stocks, or small business shares could become far more taxable. If you're holding assets, November becomes a key date. Sell sooner or plan for the heavier tax burden. Don't assume the lower rate stays just because it's been in place. Number 3. Temporary tax relief for small business and self-employed. Some of the relief measures for self-employed Canadians and small businesses, such as enhanced write-offs, deferred deadlines, or GST/HST waivers, were introduced as temporary. Now, Ottawa is signaling that unless they extend the sunset clauses in November, those reliefs will expire. That could mean higher tax bills, less favorable depreciation, and fewer allowances. If you own or operate a business, you should review the carry-forward and write-off strategies now while the relief still applies. Here's what it comes down to. If a tax rule is called temporary, assume the expiry date is real. The most effective move is to act before November, not react after. Stay alert, review the specific rules you rely on, talk to your accountant, and don't assume things will just quietly roll over. If you found this helpful, subscribe, hit the bell, and drop a comment with the tax rule you're most worried about. You'll be glad you did.